Okay, how about this is question 10 out of chapter 2. So I've got, yeah, this is always a good spot to start. So we've got short sold 500 shares at $12.50. We have the initial margin requirement of 80%, maintenance margin of 50. Are you guys getting the same numbers, or is this one of those algorithmic ones? See the same numbers?
Most of the time they're usually different.
Seeing the same.
Or, oh, mine were different.
What do you mean?
I have the same.
So you could even follow through with the different numbers. Hopefully that would give you, you know, you've got an answer. The stock is currently selling at $9.80 per share. What is Matt's equity account at this time? Ignore margin interest, $9.80 per share. Okay, so we want to know equity. So the way I like to start these out is to use that T account. Trick here is to remember which one of these is it, liability or the asset that is denominated in shares.
So we're shorting,
For sure.
then it would be, the assets would be fixed,
Right.
liabilities variable.
Shares. Yep, absolutely, good.
What about equity? Variable?
It's going to vary with the assets and liabilities. So it's equity equals assets minus liabilities. So, yep. So we've got 500 shares, and we can start. Let's just start with an open position, and then we'll shift over to the current price and see what happens. So at $12.50, and follow along here if you would, just to make sure I don't make any errors. 500. I've got 6,250. Does that sound right? This is at opening the position. And so we sell that at 6,250. So that goes into here. And then we've got an 80% margin. Remember, the weird thing about short sales is that the asset is going to be considerably bigger than the stock position itself. Although margin is always the same. Margin is net worth over value of the stock. All right. So, and when we open, we want this to be 80%. So we're going to need 80% of that. So 6,250 times 0.8. Our margin is going to be, I get 5,000. That sounds right. So we're going to put $5,000 in to open this account. That means that 5,000 also becomes the asset. So we have a total asset of 11,250, and that's denominated in cash dollars. And our liability is the one that's denominated in shares. All right, so that's how we open. Now we're told that the value of the stock is now at $9.80, which again, I always like to try to think about this from the perspective of which way do I expect my answer to go. So we're short. What's the expectation? What's your hope when you're short? Price goes down. Good. So given that 980 is less than 1250, that means, hey, this is good for us. That means our equity balance should be going up. So that's just kind of a check on what we're doing here. So we still have 11,250 in the assets, and we just have to figure out the liabilities, and that's at 980. So 500 times 9.8 I get 4,900. Right? And since equity is assets minus liabilities, just put a negative sign on that 4,900 and add the 11,250. I get 6,350. And what was the, oh, it's just, okay, what's the equity balance? Okay. Now, I could add, does that make some sense?
Yes.
Now, I could ask yet another question. I could say, well, what is our margin in this case? Again, remember, margin, no matter what it is, short or long, it's always net worth over value of the stock. Well, we've got net worth right here. Value of the stock is right here. So the margin actually in this case is 6,350 over 4,900. It's 129.6%.
Isn't it over, wait, why is it over 4,900?
Because that's the value of the current stock.
Oh,
And
okay.
and that's the easy spot to get messed up.
Got it.
Always know that this is the denominator. It's not the asset.
Okay.
Yeah, I'm glad you mentioned that because no matter what it is, long or short, margin is always net worth over value of the stock. So, I mean, and that sort of makes sense. Since we started out with a margin of 80, price went down by a considerable amount. And so, yeah, it makes sense that we actually have more net worth than we have in the position.
And the asset balance is fixed in this.
It is, it is in the medium term, unless we get a margin call. In which case, then we would have to keep the position open, we'd have to kick in more money, but obviously this direction, I mean, that would mean that price would be going up to like 15. And then we could actually work, you want to work through one of those?
Let's do that.
Okay. Any other questions though on? Yeah. Did I hear somebody? Oh, okay. All right. Okay. So. So let's clear this off. Suppose that I haven't checked this number ahead of time, so I'm not sure if this will drive a margin call, but I'm guessing it might. Let's suppose the price goes against us and goes up to $15. And again, so I'm going to use my T count. We've got 11,250 in here. We have our 500 shares. And now we're going to want to look at it at $15 per share. So 500 times 15, 7,500. So equity equals asset minus liabilities. I get 3,750. Is that what you get? So our equity stake in that case is 3,750, and divide that by the value of our stock, 7,500. I get right at 50%. So I should have done one more dollar. So here we're actually still okay. If price moves up just by a penny, we'll get a margin call because that'll drop us down below. Oh, and let me do margin is 3,750 divided by 7,500. Yeah.
So let's say that this was below the maintenance percentage and we need to add funds to the account.
Yep.
How do we know which to multiply it by to add the funds? Is it by the initial or is it by the maintenance margin?
You have to go back up to the initial.
Oh,
So
okay.
let's make that happen. Let's just say the maintenance was 60%. So we do get a margin call because we're down at 50. Right, so that was an easy change. So what do we need to do? And remember, again, this is kind of a rule that you can always go by. If you just bring it up to just where you would get a margin call, the next day, if price continues to move up, you get another margin call. Broker doesn't want to mess around with calling people every day as much as they like them, so we have to bring it all the way back up to this. Now, the question is how much more do we need to deposit in our account to get us up to 80% margin? And the answer to that is oh, well, I didn't need to erase that. You know what this is? So we're just solving for this numerator. So multiply both sides by 7,500, that cancels out the denominator, we get 7,500 times 0.8, right? 0.8 times 7,500, 6,000. We already have 3,750 in there, so that's a credit to us. So minus 3,750 from 6,000 means we need to deposit another 2,250. That also means that we get 2,250 over here. So we have 13,500. We have 6,000 in equity. Now we're back to being good. Price can move up again against us, and we'll still be okay for another couple of dollars up above 15.
So though assets are fixed, whenever we add it to the equity, we need to add it to assets.
Yes.
And that's the only time we would be adding something to assets.
Correct. Yep. That is the only time, absolutely right. Yep. And that's, I mean, that's the, when you think about it, it makes sense because we're doing double entry accounting here still, right? So whenever we put something here, it's got to show up over here somewhere. So that's, I guess the only other thing we could ask would be at what price would we get the next margin call? Got the margin call, at 15. Now we've deposited more money. We brought it back up to 80%. Now, how much higher could price go? We can use the formula sheet for that, but there's yet another way. I kind of like this way as well. Let's see if I can do it without messing it up here. So that is my net worth. So I'm taking the asset dollars, the dollars in the asset, minus the liability. That's equity, net worth. Okay. Now, what about the value of the position? The value of the position is easy. 500 feet.
Why?
Because we've got 500 shares. And we're solving for the price such that this ratio equals 0.6. So we don't know where, we don't know, we know it's something above 15, but we don't know how much higher than 15 it will have to be. Now we can do a quick little minus 500 P over 500 P, that equals 1. So now I've got is equal to 1.6. I'm going to, since that's equal to 1, I'm going to add 1 to both sides. That removes that. It adds 1 over here. So 1 plus 0.6 is 1.6. And then I need to swap these guys. So I just multiply both sides by 500P, divide both sides by 1.6. And then I've got one last thing to do. Let me do that math first, just to keep it a little cleaner. 13.5 divided by 1.6, 84,437.5. And that's equal to 500 P. And then so P is equal to 84,307.5 divided by 500. Next margin call comes at $16.87.5. Or you can go to the formula sheet and that formula is already written out. Just plug and chug. My preference, with a memory like mine, I prefer to remember one simple formula and then go through the algebraic hoops. But you guys will have a formula sheet in front of you. You're looking for the fastest way. So the fastest way would be to simply, let me pull up that formula sheet. So I never memorized that formula because I always can go back to this thing. If you were to prefer to use the formula, and here's where you want to remember, there's a different formula for the short position than there is for the long position. I've labeled it on the formula sheet, so you don't have to worry too much about it. Star is equal to initial margin deposit. I'm just going to call it margin deposit because we have actually added to it. And plus proceeds from short sale minus, oh no, sorry. Divide that by number of shares and all of that over 1 plus the maintenance margin. So I've got deposit plus proceeds, so we've got 13.5 divided by 500 all over 1.6. That should be the same. Yeah. 16,875. So my recommendation would be use that formula, but also recognize that you can still get there from other places.
Just so I can keep everything straight, so the 500 shares at 1250, that's the liability.
Correct. Yeah. Begin when we open the position.
And then 80% of that comes from you.
Correct. That's the 5.
That's your equity,
Mm-hmm.
and that's the margin deposit.
Correct. Yep.
And then the margin is that divided by the liability.
Correct. Just divided by the value of the stock. And remember, rather than say divide by the liability, because when we go to a long position, the liability is a loan in dollars. So make sure when you think about margin, it's net worth over value of stock. So whatever the value of the stock is, divide our net worth by that, and that's our margin. So in this case, 5,000 divided by 500 times 1250, which turns out to be that, is our 80%. Now, if we go down here, we've gone back up to 80%. So to get that same number, it would be 6,000 divided by 7,500. That brings us back to 80%.
What's that called when you have to add money when you get a margin call?
I don't know that there's an official name for it. It's just keeping the position open. You get a margin call, you have to either you deposit the additional funds or they close you out. But I don't know of a another term.
That adds to your equity.
Yes, it adds to the equity, but since we're using accounting, it also adds to the asset base. So then our balance sheet still balances. That making sense?
And then margin deposit plus proceeds, that's your assets.
Yes, correct. And the reason I changed that to, the formula actually reads initial margin deposit, which that formula is written assuming we don't get a margin call. But I changed it to simply the margin deposit because I want to capture, all of this extra 2250 that we deposited here. This would be the more typical problem would be one where we don't actually look at the additional money deposited. But if you can do this one, you can do all the others. Other questions?
Same topics, but one of the problems in here is 22 for me. But talks about if you purchase 100 shares, that says the call money rate.
Oh, okay. Cancel that problem. We're not going to have any interest or call money rates. Know what a call money rate is. Okay. And the definition of that is basically the rate at which your broker borrows money for you. The broker borrows at the call money at the call money rate and adds some sort of little extra to it so that they get something too. Allegedly, that's what they think. In today's banking world, they probably lend it to themselves, and they take both. But, call money rate originally was the broker borrowing from their banker, passing it on, adding another percent or whatever, and then so your payment is call money rate plus 1%, 100 bips, they might say, which means 1%. 50 bips, which means 0.5%, or basis points is bips, BIPS.
So we wouldn't have to calculate interest or like 6-month interest?
Nope.
Okay.
And well, the book is not wrong. I just don't like the way they present that whole thing. They talk about assuming that your holding period is X. And the way it just seems all backwards.
Okay.
So I'd rather not confuse the issue, because normally when we talk about compounding, we talk about a nominal rate. And in the book and in the problems, they give you what they call an effective rate. So you're kind of backing this out. They don't give you effective rates. They give you a nominal rate in the real world. And so I just don't want to create any more confusion. So you know what a money call rate is, but don't worry about working the problem. At least, let me revise that. There will be no interest calculations in margin positions, long or short. Now, I might ask you to calculate an effective interest rate or a return or something like that in another chapter, but as it pertains to margin, don't worry about it.
Effective interest rate, effective annual rate of return.
Mm-hmm. Yeah, right. So say you get a return of 5% on a quarterly basis. Tell me what the effective annual rate of return that is. So if you just got 5% quarterly, so 4 times, a nominal return would be 20%, but the effective rate says, well, wait a minute, you're getting 5% this quarter, and you're rolling not only the principal, but the 5% into the next quarter. So you're getting 5% on the original principal plus that interest from the first quarter. Then you're rolling both of those interest payments plus the principal into the third quarter. You're rolling all 3 interest payments plus the principal into the fourth quarter. So the effective rate becomes basically, you're doing something like Let's see, so 5% quarterly would be 1.05 raised to the fourth minus 1. I get 1.2155 minus 1. And so that's 21. That would be the effective rate. Make sense? And you've got that in the formula sheet there. That's actually up in chapter 1. So, okay, so this is a good one to work on because that's often one that is easily confused, especially the short position. Long position's a little more intuitive. We could work one of those or we could move into something else. So, totally up to you guys. Gals. Pardon?
Alpha, I wouldn't mind working on,
Okay, along, you want to do along?
so we can compare it.
All right. I can just, why don't we just make one up? So let's say we have a $50 stock and we've got a 60% initial and maintenance 40%. And we have, I don't know, let's say numbers that aren't going to get too funky. Yeah, let's say that we have $30,000 of our own money. That's our equity stake. All right. So somebody, I'll let you all do some of the calculations here. I'll just follow along. How many dollars can we buy? How many dollars of stock can we buy with both our own money plus what we borrow if our initial margin is 60%?
600.
Say again.
600.
No, we got 30,000 to start.
Oh, I thought you meant like how many shares you could buy.
Oh, gotcha. Now start here. Okay,
Borrow, 50,000, right?
you can have a total of 50,000, 20 of it is gonna be borrowed,
Okay.
right? So basically, we got this, we got 30, and we're looking for that, right? So just multiply by x divided by 0.6, and you get that x is equal to 30 over 6. Now we take our 50,000 and we divide that by the share price. And so that means we can buy 1,000 shares. So now we have, and the other quirk here, remember, the share denominated part of this balance sheet is the assets. So we have our 1,000 shares over here. And right now that's worth $50,000. Our liability, opening liability is 20,000. And so that means that our equity is 30,000. let's not do the price going up because that's just too easy. With price going up, our margin, percent margin would go up, right? Because that's moving in the direction that we're hoping it to move, and we don't get a margin call at all. So if the price went to $60, we would have 60 times 1,000 or 60,000 minus 20 equals 40,000 equity. And that would mean that our margin at that point would be 40,000 over 60,000. 0.667. Right? So anytime the price moves in our favor like this, it should be relatively easy. So let's do price moving down. In fact, before we do that, let's try to figure out at what price we'll get the margin call. So let's solve for P star. Again, that formula is going to be a little bit different. It's labeled on the formula sheet, so make sure you follow that. That is the amount borrowed over the number of shares. Divided by 1 minus the maintenance margin. So we've got, we borrowed 20,000. We have 1,000 shares. And we have a maintenance margin of 40%. And so we've got 20 over 1.4. I get 14.2857.
One minus.
No, that's wrong. Yeah, 1 minus, thank
0.6
you.
on the,
I knew I was messing up there. Oh, no, that's. Right, okay, now I get, thank you. All right.
0.6 be 1 minus 0.4.
Oh, 0.4. I had it right the first time. All right. Thank you. So that's 20 divided by 0.6. I get 33.
Yeah.
Okay. So that is the price at which we'll get margin call. Another thing we could do is to say, well, let's figure out what our margin is if we drop below that, and then how much we could need to deposit to keep the position open, and then we've kind of completed the loop on this thing. So let's say that the price drops to $30. So we know for sure we're going to get a margin call. But we also want to figure out what's this look like at 30. Oh, I should have left. We got 1,000 shares over here. And at $30, that's 30,000 on the asset side. We've got 20,000 that we owe somebody. So our equity is assets minus liabilities. And by the way, these parentheses are not negative. Sorry, I guess I could have put it in brackets. Maybe. Don't want to confuse the issue. So we end up with a equity stake of 10,000. And so it doesn't take too much to say, well, let's see, we've got 10,000. Wait a minute. Yeah, okay, here we go. Yeah, 10,000 divided by the value of the stock, which is here. 10 over 30 is 1/3. That's below our 40% mark. So we will get a margin call. Now, then the next question is if we want to keep the position open, how much more money do we need to deposit? And there we can go back to our margin formula. And we're solving for 40%. No, sorry, we're solving for 60%. We need to bring it up to the initial margin. We know that let's see. We got 1,000 shares. And why am I drawing a blank on this? Oh, at $30. All right. So that's 30,000. It's all correct. So we're going to take, we're going to multiply both sides by 30,000. And then do the left-hand side. I get that X is 18,000. Everybody agree?
So this means you have to put in 8,000, right?
Correct. Okay. We already have 10. So we need to add another 8. It gives us 18 on the equity side. We add that same 8 over here. That gives us currently 38 on the asset side. And again, that's as far as we'll ever go. We won't have to worry about interest. We won't go further than this. Questions? Do it a couple more times and you should have it down solid. What else? Or more on this is fine too.
I know I asked this earlier, but did you ever figure out if we needed to know the standard deviation and variance?
I did not look that up and I haven't made the test yet. I will add it if we do need it. Trying to see, do I have it at the very end of this? No. Did you use that on one of the homeworks? You said it was in the study for
Yeah, it was.
the optional stuff for the midterm.
Yeah, it's question 3.
Oh, okay. Let me go back and grab that.
Yeah, I'm all for you keeping it off.
I understand. Let me see if there's any reason to add it in.
As long as you have a calculator.
Oh, yeah, yeah. I think we had that in some homework too. I
Yeah.
think, regular homework.
Yeah, I thought I saw some variation of it.
Yeah. Let me add that to the formula sheet.
All right, thank you.
I didn't see whose hand was up first, but go ahead, either one of you.
Here you go. All right, also geometric and geometric return, will that be on the formula sheet too?
Well, certainly could be a question.
Is it on there?
Let me see where it is.
Chapter 1.
Yeah, it's in chapter 1. Yep. Yeah. I mean, there is no arithmetic one because all that you're doing there is just adding up divided by the number of observations. But the geometric one's that last one on chapter 1. And let's see, you had a question?
Oh, I was just making a point, like, do you think it would be easier to use a graphing calculator on the test rather than
Then a BA2 plus.
Yeah.
You're certainly welcome to, let me put it that way. If you want both of them, I don't have an objection, just please don't fill registers up with stuff, it's probably not gonna help you anyway, just take away from stuff. So, yeah, I'm fine with either or both.
So, hold on, how do you calculate the margin?
For which one?
The one we were just working on before we, so when we got the margin column, so price went to 30.
Right. So price went to 30, we have 1,000 shares, so the value of the stock is 30,000. we're looking for, you want to know how much we need to add? Is that? Sorry, I made
What is
the current margin before we get the call? Is that what?
That price,
At the price of 30, okay. So it's, we have 10,000 in equity and the value of the stock is 30,000. So that would be 33.33%. 10, which is our net worth, over 30, which is the value of the stock.
And then once we add the funds, the new margin is 18,000 over 38.
Right. 18 brings us back up to 60. Yep. Okay. So anything else on there? I mean, honestly, I think that's probably the most confusing chapter, when we're talking about margin.
I was just, can we go through some valuation?
Sure,
questions?
absolutely.
Just like, if you, I don't have one that I picked out, but.
Out of chapter 6, right?
Yeah.
So, something like problem 1, you're given you got a stock that pays a regular dividend of 70 cents per share for each of the next 4 years. At the end of 4 years, the company will also pay out a liquidating dividend of $73 per share. And the company will cease operation if the discount rate is 10%. What is the current value of the company's stock? Is that one that would make sense to go over, or is that? Okay, all right. So this is problem 1 out of chapter 6. And so we have 4 years. And we have a dividend of, what did they say, 70 cents?
Yes.
70 cents, and at the end of that, we have a liquidating dividend of 73 cents.
I think it's $73.
Or, sorry, yeah, $73, thank you. And the discount rate, our K, is 10%. All right, so, and this is where you can really apply the basic 312 stuff to this. In fact, most of this, remember, always keep in your head that we're either discounting back to today or moving something out into the future. For the most part, that's going to work with a few tweaks. So we've got 70 cents per year for 4 years. At the end of that 4-year period, we got another $73. So I like to put these on a timeline. And so that very last payment is the one that might trip you up. And just remember that we're talking about dividends in the future. And if you're not told differently, assume that the dividend payment occurs at the end of the next year. So here's our first dividend, second, third, fourth. And then they say at the end of the 4th year, it also pays a liquidating dividend of $73. And so now we just have to discount this whole thing back. So we can simply take 1.1. So 1 plus K raised to the first power plus 1 plus K raised to the second plus 1 plus K raised to the third. And then this actually could be rewritten as 7370 raised to the fourth. Do the calculations, add it up, And we ought to get 5208. You there? So I would say, one of the key things I think when you're learning this stuff, is when in doubt, assume that it's basic 312 type time value of money stuff. The trick is making sure that you get the timing right and you line up the payments where they should be according to the problem, and that's where the timeline is all valuable. So make sure that you use that timeline. I don't necessarily see it just right on the paper and plug in the numbers, and then you're less likely to make a mistake. I like to do the timeline no matter what. No matter how many times I've done this, just to make sure I'm not messing up timing. Because that's usually the thing that happens. Somebody messes up the time. If you plug this in here and here and here and here instead, if you thought of it as at the beginning of the year, then it would not work out to be 5208. Would it be higher or lower? If we move the payments to the beginning of each year. Be higher, right? Anytime I can move stuff back towards today, it's always more valuable. Are we in somebody's room?
Probably not.
We'll go with that.
It's a 7:30 class.
Is it really a 7:30 class? I don't know of a 7:30 class, but there could be. It is, we can change the day of the week, we can change the time. But let's see, we can go to another valuation problem.
Yeah.
Should we do valuation with, the capital, model without dividends, the equity?
The residual income model.
Yeah.
Written, okay, sure. Yeah, absolutely. Sign one was already set up for us. The first 8 are all dividends, then we go to free cash flow. Maybe number 11. Huh. Did I not put a residual income model on the homework?
There is one.
Do you know offhand which number it is?
Yeah, I'll find it.
Let's see. Dividend discount. Rate. So. I get to, I think it's number 7, right? Question 7. Equal duties. Engages in the development, manufacture, and sale of a line of cosmetics designed to make your dog look glamorous. Below, you will find selected information necessary to compute some value estimations for the firm. Assume the values provided are from year-end 2019. Also assume that the firm's equity beta is 1.4, and the risk-free rate is 2.35 market risk premium. MRP is 6%. Okay, so yeah, that's one. Let me jot down these numbers so you can see. No, wait a minute, that's not, they give us a dividend. They do give us a book value of equity.
It was number 58. It was finding the share
Oh,
price.
in the study, okay.
Yeah, in the study review, and it's using RIM with constant perpetual earnings growth.
Perfect. Thank you. Yeah, okay, Bill's Bakery has current earnings per share of 274.
58. No, I just read it.
Current book value of equity of
We
460.
probably do.
Discount rate for Bill's Bakery is 9%. Earnings grow at a constant 3.6. That's it. So we can use the RIM out of the equation sheet. We can use either one of those formulas, it doesn't matter. They all amount to the same amount. I'm gonna pick the first one at the top of the page 3. And so that formula looks like this. And just to kind of reinforce that intuition here, assuming that book value is an accurate estimate of the value of the assets and the value of the liabilities, the value of the equity then is an accurate market estimate. So that's why that's there. But to that, we are going to add any residual income that we make above and beyond what's required. This is what's required. Required rate of return on the book value of equity. That's what we should be getting. Here's what we actually get. And if we do that on a regular basis every year after year, we can assume that's an infinite thing. We know that growth, we assume that growth is constant. So we divide by that K minus G, just like we did in the dividend discount model. And so now it's really just plugging. So book value of equity, 4.60 plus EPS, and that was just paid, right? Current earnings, so, yep. So that's 274 times 1 plus 0.03, was it 3%? 3.6. And I'm gonna run out of board space here, but let's go with B0 against 460. Times K, or 9%. And divide all of that by K minus G. Now let's just do the math of division actually. And so 4.6 times 0.09. So we should get a return of 41.4 cents. And I'm just going to store that in the register. We actually get a return of 274 grown at 3.6%. 6 times 2.74. So we actually get 283.86. Minus 0.414. all over. Four. And this is 6. So get 2.836 minus 0.414 divided by 0.054. I get 4490. Does that sound like what you are getting? Plus 4.6. I get 4950. Or yeah. So again, just to point out some of the tricks and spots where you can easily get tripped up. Make sure you get the right book value. This is book value of equity only. Note that this says EPS 0, so that's the one that just occurred. So read carefully. If it says the current EPS is, assume that that just occurred, or just paid, assume that just occurred. So that's 0. Now, if they say the expected EPS is, then that's going to mean that's EPS 1. So you wouldn't need to grow it. You would just get rid of that. Because remember, EPS 0 grown at the growth rate of earnings is equal to EPS 1. So read carefully on the problems. And then the rest of it is, this is book value of equity again. This is the discount rate, and then discount rate minus G. Like I said, you can use either version of those formulas, whichever you're most comfortable with, and you can do most quickly. Doesn't matter, you can just hang out. What others? Any others that?
Going off that, then we do.
Yeah. I think there's one in the regular homework. Right. Nine. Okay. Yeah.
So I know you have to use the dividend discount model when I stock pays dividends. Dividends, when would
In either case. So, yeah, so yeah, here's the way the problem is worded. It's going to lead you to, they may outright say use the free cash flow model. They may not give you a dividend. And that would be a sure sign that you're either going to use free cash flow or RIM. A lot of it has to do with what sort of information they give you. If you have any doubts on the exam, I'm always open to a question. So if there's any doubts about what they're asking for, and I'll try to make sure as I read through the questions that it's pretty clear as to what we're looking for. But free cash flow and RIM can be done on stocks that either pay dividends or don't pay dividends. So it's a very open form, it's very open to varieties. Dividend discount model, only if the company pays a dividend. So that's part of it. If you don't see dividend listed in the problem, you're definitely using either free cash flow or RIM. If you do, then more than likely you're using dividend discount.
So if I use cash flow instead of RIM, I'll get the exact same answer.
Now that is a good question. Depends on what kind of numbers you're given. Theoretically, you should, yes. But yeah, not always. You're not always gonna end up with exactly the same. Part of it is that you might have a different growth rate assumption for cash flows than you have for earnings than you have for dividends. And at least in the short run, that can lead to a different answer. Let's see, so let's do, you've been tasked with using the free cash flow model to value Julie's jewelry company. After your initial review, you find that Julie's has a reported equity beta of 1.5. That's the other thing that you're gonna find if you're given an asset beta, you know for sure you're probably dealing with a free cash flow problem. Okay, beta equity is equal to 1.5. Debt to equity ratio of 0.5, a tax rate of 21%, market conditions, a risk-free rate of 4%. Market risk premium of 11%. If Julie's had free cash flow last year of 47 million. And has a current outstanding debt of 119. Find the value of Julie's equity, assuming a 3.1% growth rate. So let's add G up here. 0.0. Okay, so now we've got all the information we need. Then we can go to our equations, and we're going to need a couple here.
Which question is this?
Oh, this is number 9 on chapter 6. So you can start one of two directions. It doesn't, well, actually it does matter. You're gonna have to, since we're valuing in these problems, the way your authors chose to go was to use free cash flow to the firm. They call it FCF. I add the second F to recognize that they're really talking about free cash flow to the firm, not free cash flow to equity. Sorry. So that means that we're valuing the entire firm, including the debt. That's another tip-off for the free cash flow model. If they give you the market value of the debt, and they give you an equity beta, and they give you a debt ratio, and they give you free cash flow, you know you've got sufficient information to answer the question with the free cash flow model.
So to the firm also, is free cash flow to assets.
Say that again.
So free cash flow to the firm is also, it's like free cash flow to assets.
Correct. But assets is not a claimant, right? Assets is just assets, but they are one and the same, absolutely. So really what you're doing, you're looking on the right-hand side of the balance sheet versus the left-hand side rather than the right-hand side with the assets. So we're looking at the entire value of the asset base. And then what we want to do at the end is to split it up between equity and debt. Okay, absolutely. Okay, so the first thing we have to do is we have to figure out what is our K. But before we can figure out what K is, because we're valuing the asset base, instead of just the equity base, we need to convert this equity beta into an asset beta. And if you look at the formula out of chapter 6 for that, you will see that where are we? Oh, here. So they have equity beta equal to the asset beta times 1 plus debt over equity times 1 minus T. All right, so what that's really saying to us is that the equity beta is equal to the asset beta, and then it's increased by something related to the after-tax debt in the firm. The other thing to keep in mind, if the problem really wants to trip you up, you could see this, I'm not guaranteeing anything. Rather than give you debt to equity, might give you the debt to asset ratio. You'd have to figure out what the debt to equity is based on the debt to asset ratio. Here, we're actually given debt to equity, so it's a direct plug. If we're given debt to assets, we would have to figure out what this is. So if this is 0.5, let me give you what the debt to asset ratio would be. I like to look at this. Can anybody tell me what the debt to asset ratio is? Given that I've rewritten this to actually explicitly show you the denominator, the equity piece. So how would you write the debt to assets? Any ideas? Go back to your, oh yeah.
So you add them together for assets, that's the
Yes,
denominator.
great, excellent.
That is-
And so you'd actually, if you were given debt to assets, it'd actually be 0.334. 0.33333. And you'd have to make that conversion. And how do you back that out? Well, you do kind of the reverse. Well, let's see, we could write it like this. Debt to assets is equal to 0.333. And again, we could do that. And we could recognize that this is the entire asset base. This portion of it is financed with debt. So the other 0.667 is financed with equity. So if we were to write 0.333 over 0.667, we're going to get that. So that could be one additional twist to the problem, is that you're not given this directly, you're given this, and then you got to figure it out. Assuming we've gotten to this point, then it's really, we're just plugging in 1.5. We're solving for beta for the assets times 1 plus 0.5 times 1 minus 0.21. One minus 0.21, 0.79, 0.5, 0.395 plus 1. Keep your order of operations. You know, always exponents, roots, and then division and multiplication, followed parentheses, and then subtraction. So I get 1.395 for the bracket inside the brackets times the beta on the assets. So what I'm going to do is I'm going to divide both sides by 1.395. So I divide that by 1.395. Can't write left-handed. So that comes up to be I get 1.075, right? Now I have a asset beta. Now I can use that asset beta to get a K. And my formula for K is the risk-free rate plus the beta times the market risk premium. And that was 4% plus 1.075 times 11 I get 0.1583. Right?
That's the capital asset pricing model.
Correct. Yep. Yeah, we can use that same model to value assets, equity, debt, you name it. We can use that model to value it. So that's 15.83% on the K. And we're just about done doing the upfront work on this. Let's see. Yeah, I think we're good. So now we've got this number. I'm gonna write that. Oops, I still need that sheet. Okay, up here. Get rid of all this. Now we can go down to our the actual valuation formula, which looks a lot like the dividend discount model. So they say the value of the firm is the free cash flow at time 1 divided by K minus G, or the free cash flow at time 0 times 1 plus the growth rate of cash flow divided by K minus G. And we have the latter. So we're going to plug in 47 million times 1 plus 0.031. And we've got 0.1583 minus 0.031. That calculation. And 47. I get 48.457 for the FCF1. Divide by, oops. Something to miss in my numbers here. 8 minus 48.457. 3 minus that's better. I get 380.65. So that's the entire value of the firm. We've still got one more step to go. And that is to get the value of the equity, we have to subtract the value of the debt from the total value of the firm. So it's 380.65 minus 119. I get 261.5. Yeah, that should be 380. It's so that's free cash flow yesterday, grown by our growth rate to get the free cash flow. So that was what, 48, what did I say?
45.
Yeah, yeah. And then divide by the difference between these two.
They gave that growth rate in the question.
Yeah, the growth rate was given. Yeah. Did you get it?
Yeah.
And then subtract off the 119. And you should end up with 261.65. For some reason, the answer in the problem comes up with 261.71, but they give us a 2% buffer. So I must not have carried out decimals somewhere as far as they did. That help? the only other really, I mean, dividend discount model, kind of the same deal. We've looked at RIM, we've looked at free cash flow. The only other one we could do is a relative valuation. We can run through one of those quickly.
Thank you.
You're welcome.
As far as like rounding goes on the test, like let's say like we don't like round it, like, or like we don't use the exact, like is there enough for like buffer?
Yeah, go for the closest answer.
Okay.
Yeah, absolutely. And they shouldn't be so close that you're gonna get, the wrong answer. And if you do, I certainly am open to going back and looking at a question. If you show your work on the exam, there's always going back to look at it. And I don't leave that out at all. Even though they're multiple choice, I'd certainly look at how you work through it, see if there was just a rounding error. Let's see. Not finding here, well, I've got a calculation here for finding the PE. Oh yeah, here we go. I think it's problem 6. I'm not going to do all of these. So given the information below, Seegert Corporation computed the expected share price at the end of 2020 using a price ratio analysis. Assume that the historical average growth rates will remain the same for 2020. All right, so, and I'm not going to give you a problem like this where you're going to have to calculate a historical average growth rate to get your relative price valuation. I know you all can do that, so that's not going to be part of that question. Number 6 and the homework was extraordinarily long. So what you get is you would probably be given a growth rate for that particular element, either cash flow, earnings, or sales. And then you'd be given the average PE, PCF, or PS ratio. And then you'd be given the appropriate EPS, free cash flow to equity, or sales per share. And from that, you could calculate it. So let me just grab one of those numbers here. Let's do just a PE valuation. So we've got an average PE of 18.43. We have a EPS just paid of $8.40. And we have a growth of EPS of 21.56%. So you're asked to find the value using the PE relative valuation, and simply stated, what we're going to do is we're going to take this EPS and project it out into next period. So we get EPS 1, that's simply EPS 0 grown at G. So EPS 0 times 1 plus this. So we've got 8.4 times 1.2156. And that's going to equal I get 10.21. So that's our projected EPS for period 1. And regardless of whether this is the historical average of the subject company or maybe it's a average of the cross-section of comparables for that particular company. Either one, doesn't matter. All we do is we take the projected EPS, this is next year's, times what people are paying for $1 worth of EPS. Remember, this is P over E, which means we're really writing 18.43 over $1. So every dollar's worth of earnings, the market is valuing at $18.43. So now it's a simple matter of 1021 times 18.43. I get 188.19. And that's it. And you can substitute, you know, if we're doing price to cash flow, this is price to cash flow, this is cash flow per share, this is growth of cash flow per share. Otherwise, the process is identical. If it were price to sales, otherwise the process is identical.
Didn't we talk about, so like in the question you gave, like, since these are like looking back, isn't this like not a great way to?
Yeah, in the question, they're using historical of the company itself, which is not the best way to do it. Yes, correct. It's better to look at, you know, if you think of, I'm standing at time 0. Behind me is the company. So -1 year, -2 years, -3 years. I get all of the PEs for those 3 years divided by 3. That's what they're using. Better way is to stand here and look to this side and find 2 companies like this company, another 2 companies, add those PEs up, divide by 4. I get a number and I still do the same exact process. It's just, where does this come from? But you're absolutely right. Historical, it's great for working a problem and showing you kind of the basic idea, but it's not so great when you're actually looking at real market conditions. Yeah, absolutely. Okay.
Where did you get the 1.2156 again?
Oh yeah, that is given to us in the problem as the growth rate for actually earnings.
Oh, okay.
Yeah. Now you were given some raw numbers and you had to actually calculate the growth rates. You're given 6 years of numbers, and so you do the intervals. You do, you know, EPS went from 320 to 391. You can calculate that percent return. Then it went from 391 to 471. Calculate that percent return. Do it 3 more times. Add it up. Divide by 5. I'm not going to ask you to do that on the exam. That'd be a waste of time. I want to see whether you can actually implement this model and make it work. I know everybody can calculate a percent return. But yeah, it wasn't actually stated in the problem. It's part of the solution to this particular problem. Other questions?
This has to do with like chapter 6 homework question 2.
Okay.
They asked about the sustainable growth rate,
Yes. Yes.
and it's not like hard to find anything, but you need to know like the retention ratio.
Yes.
Is that gonna be provided like in the formula sheet, or should we?
I can add that. So let me just say in words what it is. It's 1 minus the payout ratio. But I can certainly, I didn't add that in there. Right. Let's see, where is, oh, here we go. No, I didn't. Okay, yeah, I'll add that in. Yeah,
Thank you.
sure, you're welcome. What else? Everybody ready to go study? Study?
What is the sustainable growth rate of the rest of the company can grow?
Without issuing any additional equity. Just on its own. So the retention ratio is how much of the earnings the company keeps. So, yep, you're welcome. And so it's basically, one minus what it's paying out. So if it pays out, let's say we've got a dividend of $1 on earnings of $2. The retention ratio would be 50%, and the payout ratio is 50%, but 1 minus 50% is equal to 50. That was a bad example. Let's say that we had a dividend of $4 and earnings of 6. So that would be a payout ratio of 2/3 and a retention ratio of 1 minus that, which would be 1/3. So it's that 1/3 that we retain, that $2 out of the 6, that we then put back into the asset base. And the next year, we now have whatever the original was plus an extra $2 per share. And so we're going to deploy that and earn what we earn on the other original asset base. So that'll grow the company. And so next year, the earnings, instead of being $6, will be, I don't know, I'm making up a number here, but it might be $6.25. That year, we pay out 2/3 of that in dividends. We keep 1/3, reinvest it, and we go forward and keep doing that, iterate. So that's the idea behind sustainable growth. In other words, we're not going out issuing more equity, not issuing more debt.